Hi, everyone. So glad to be here. I would like to talk a little bit about dimensional fund advisors and then introduce Apollo, our speaker for the day. So, Dimensional Fund Advisors is a global investment firm that translates academic research, including research from University of Chicago scholars, into evidence-based, factor-driven investment strategies. Most of the investment portfolios that Andrea and I recommend to our clients include at least one dimensional fund holding, sometimes more. Dimensional collaborates with advisory firms like ours, and we're fortunate today to have a subject matter expert from Dimensional here with us, Apollo Lupescu. Apollo Lupescu is vice president at Dimensional Fund Advisors. Known for his ability to translate complex investment concepts into clear, sensible language, Apollo has earned the nickname of Secretary of Explaining Stuff. I love that. Apollo brings over 2 decades of experience at Dimensional, where he applies the analytical rigor developed in his earlier career teaching at University of California. He holds a PhD in economics and finance and a BA in economics. And in college, he competed in and coached water polo. So lots of fun there, I'm sure. Apollo. We're so happy to have you here today. And I'd like to kick off our town hall with the very first question, which has to do with recent geopolitical events, particularly in Iran. I think that's particularly relevant, given everything that's been happening. So the question is, the recent events in the Middle East have introduced fresh geopolitical uncertainty, potentially causing additional market jitteriness, which we've seen and continue to see even today. How have oil prices and stocks reacted so far? And what are the implications for investors looking ahead? Are there any actions that we should take right now,
Right.
given the uncertainty around this whole matter?
Yeah, no. Well, first of all, Andrea, Jackie, thank you so much for the invitation to be part of the webinar. And It's such a good idea to have educational sessions to sort of demystify some of these big issues of the day and what it means to investors. And before we discuss the markets, I think it's important to acknowledge the human toll of these events and also the emotional toll that it's taken on all of us. Whenever we watch armed conflict and bombs falling and people dying, and you have all these things happening, it's just really emotional and distressing. And I think it's perfectly normal to have a sense of anxiety that things are not going right and what's going on in the world. So I just want to start with that and just say it's perfectly normal. That's what makes us human to have these emotions. I think it's hugely relevant to all of us to acknowledge them. And at the same time, when we think about investing, what we want to do is acknowledge the emotions, and at the same time, disentangle these emotions from investment decisions and make sure that whatever decisions we make, they're made not based on emotions and how we feel, but rather data and very pragmatically looking at the evidence and what it means to your money. And to your point, are there any decisions to be made? So in that respect, when you think about the Iran conflict, there are three really important tenets that every investor should acknowledge. The first one is that the stock market is processing the ability of a companies to make money, not morality. I know it sounds cold, but the reality is that the function of the stock market is to assess the impact of this geopolitical event, in this case, the Iran war, on a company's abilities to make money. And why is that? Well, when you buy a share of McDonald's or a share of United Airlines or Facebook, Nvidia, all Apple, all these companies in which you can buy ownership, we have to figure out, well, how much should we pay to own a piece of that business? And the function of the market is to figure out, what do I expect that company to make in profits? Because as a part owner into that business, I can take home some of those profits. That's the intuition behind the stock market. You are part owner into a business. And as the business makes money, you are entitled to some of those earnings. So in that respect, when a geopolitical event happens, the function of the market is to look and say, given what just happened, what would this impact the ability of a company like Nvidia that makes AI chips, or Facebook or Google or McDonald's to make money down the road? And when the conflict arose, the Monday after, you saw an example of this. You saw that American Airlines, that has flights going to the Middle East, the stock dropped by 3-4%. At the same time, Lockheed Martin, which is the company that is a defense contractor, went up by 3-4%, because the same exact geopolitical event had completely different impact on their prospects for earnings. But by and large, what we saw the market on that day doing is pretty much stay even, stay flat, not much has moved. And not because the market is not paying attention, it's just simply saying that the majority of US companies will not necessarily be impacted given the information that we had on that Monday. That, hey, we bombed a few things, we killed our leader, but based on what the information we had, it didn't seem like it would tremendously impact the profits of a lot of companies. Now, as news emerged that perhaps the oil channel, which is a little narrow passage where all the oil boats apparently go, about a fifth of the global oil supply goes through the Strait of Hormuz, which is a very tight a space between Iran and Oman. As that got shut down because of the war, there was certainly a realization that oil might go up in price because you're not going to have as much oil flowing through that area. And that's exactly what happened. And then as information came about, hey, there maybe the boats can go through. Oh, wait, they can. The price fluctuates based on information. But that's the function of the market, is to fluctuate and prices information. So by and large, Jack and Andrea, the markets, what they've processed so far is a fairly limited impact on most American companies. And in some ways, most global companies, but it is company by company. Just to be sure we gotta follow that thread. So far, it's a more of an emotional toll than it has been a toll on the bottom line of companies. So that's the first element. Markets are processing the uncertainty in companies' profits, not the moral aspect of the conflict. Number two, if you look at the history of conflicts in general, and we like to look at data, and when we look at the history, what we see is that whenever we have a conflict like this, whether we had World War II, we had the Cuban Missile Crisis, we had 9/11, we had tariffs, all these things that are happening, they tend to trigger a pretty sharp short-term volatility. And yet, in every historical instance, the markets have proven remarkably resilient. And they continue the upward trend, once we get past that initial moment of uncertainty. And a great illustration of this, and I know it's an extreme example, is looking at World War II, because as you go back to September of 1939, when Germany invaded Poland, and you kind of say, well, this can't be good. This is a horrific thing. There's a lot of volatility in the market. And then you fast forward to the end of the war, which is in August of 1945, when Japan surrendered. What you see is that over the course of those 6 years of war, if you look at the U.S. stock market and the reaction that it had to the war, and that's an extreme example, it basically doubled in about 6 years, despite the war, which is nuts if you think about it. That the stock market doubled despite the having a global conflict. And certainly we got pulled in December of 1941 with the Pearl Harbor attack. And if you look at the years when the US was directly involved in the war, 42, 43, 44, and 45, in every single year, the market went up. Every single year. Every single year, the market went up. So the reaction, if you look at the historical reaction to conflict, it just doesn't appear there's necessarily a doom and gloom for investors. And why? Not because war is good for business. It's the first point that I made is that, markets are processing a company's ability to make money, and companies are resilient. They're creative. They're going to innovate. So what happened in World War II is that when Cadillac could not sell their cars, they put the engine into a tank and they sold that to the government. I'm not sure it had power windows and leather seats, but it was a Cadillac tank. Ford was making airplanes, and the toughest Fords ever built are not the F-150s, but the tanks. And that's when Jeep got started to provide a military vehicle to the Army. So the second point is that when you look at the historical data, once you get past that initial volatility, companies adjust and the markets therefore adjust. So we don't really see a solid reason for you to jump out of the market at this point based on all the negatives that might happen, because those have already been priced in. And the third point, which I think is hugely important to all of you, is that when you work with a financial advisor like Jack and Andrea, they have built a plan for you. And the plan was built to withstand an unpredictable world. In other words, this is not a situation like you just wake up, wait, what do I do now? Your plan has accounted for the fact that at some point we'll have some uncertainty. And even though nobody possesses a crystal ball, not even I do, the portfolio is globally diversified. So it has so many investments. It has different types of investments. It has ownership in companies. It has lending as bonds. It's a real estate investment trust. All of these were built to withstand periods of volatility. So, at this point, it's a great idea to review with your advisor the portfolio, but know that a plan was built to withstand times like this. And because of that, what we caution people is of the danger of doing something. Let's do something because look, the world's falling apart. Let's do something. And I think that particularly the media thrives on these worst case scenarios, and then reacting to these events and like a knee-jerk reaction, a lot of times emotional reaction is not a good idea. So ultimately, when we look at these events, Jack and Andrew, we kind of see that it's very emotional, and it's legitimately emotional because it's hard to watch, and the anxiety that produces. At the same time, you do have a plan. People have a plan, and the markets have already priced in, and the expectation is that once the initial volatility goes away, we'll get more clarity. But historically, the market has done a really good job recovering from these events.
Yeah, that's so insightful. And I think it's a very good point. It's easy to have that knee-jerk reaction. The media thrives on all of that.
Right.
If they weren't announcing some huge event every moment, then we wouldn't all be so attached to our screens and wanting to follow all of their news cycles.
Exactly. I mean, that's exactly what the media is doing, is tapping into our emotions.
That's right.
And you have to acknowledge that the role of the media is not to make you a better investor. It's theoretically entertainment. Sometimes poor entertainment, but it's entertainment, not advice. If you want advice, talk to your advisor, not to CNBC or CNN or Fox or whoever you might be watching.
Yeah, that's a very good point. Yes, thank you for that. And we talk to our clients about that all the time. The plan that we have, we need to trust in the plan and know that it was built with their specific circumstances in mind.
Yep.
I'd like to turn to on our next topic, which is sort of related, which is about the Fed and inflation and interest rates. And
Right.
related specifically because oil prices, you mentioned the Strait of Hormuz and everything that's happening there. So in 2025, the Federal Reserve started interest rate cutting again. And there was a potential for more interest rates to come in 2026. But
Right.
now, recently, here we are with the Middle East things happening, and inflation expectations now are higher because of oil prices, at least in the short term.
Right. Right.
So, can you
Right.
provide us some perspective on the Fed's actions and timing, and kind of what that might look like for this year going forward?
Yeah, absolutely. And I think it's really a key insight here. So when we're thinking about the Fed, the way that we know the and love the Fed, and by way of history, the Fed has been around for over 100 plus years. And for a better part of its, for the first, I would say half of its history, the Fed did not have much of a role in what's called monetary policy. So if you hear these two words, monetary policy sounds important, probably is. But what monetary policy is the ability that the Fed has to release dollars in society. The government cannot put money in society. The government has to spend only the money that it collects in taxes or whatever it borrows through government bonds. But it doesn't really have the ability to just what's called print money. The ability to quote unquote print money rests with the Fed. They're the entity that can do that. And I think that what's important about that is that with a stroke of a key on a computer, the Fed can just push money in society. And it has had this ability since the 70s, since the mid 70s. Before that, it did not have it, but because the dollar was tied to gold, so the Fed could not just release money in society without having gold in the vault. But today, since 1970s or so, the Fed has been able to release money in society. And what the Fed was given along with that is two mandates. And one mandate is, hey, you got to keep prices stable. We want to have prices stable in the U.S. Economy, and the Fed was tasked with that responsibility. And the second mandate, which is called a dual mandate because there are two of them, is interesting because sometimes it can be in conflict. And the second mandate is that we want people to have jobs. We want the economy to just hum along and have full employment. As many people get jobs as they want to have jobs. So that's the dual mandate of the Fed is you promote economic growth and at the same time make sure that prices are stable. So how does the Fed do that? Well, if it finds there are times when, for example, the economy needs to be stimulated, for example, like there is a slowdown and there are not a lot of jobs and the economy is in a recession, what they might do is just say, well, let's make it easier for businesses and consumers to borrow money. And they put a lot of dollar bills in society, and by doing so, interest rates they tend to drop. And when that drops, that triggers economic activity, and then basically employment goes up and everything's happy. The trouble is that you have the second mandate with inflation. So sometimes if they see that prices are going up and up and up, what the Fed is saying, wait, let's increase perhaps interest rates, make it harder for consumers and businesses to borrow. And by doing so, perhaps we slow the economic activity and also the prices go down. And that's a dual mandate. So it's a little bit in conflict with each other. Now, what the Fed has learned, in my opinion, going back to the 70s, is that the more important mandate of the two is inflation. That is by far the more important one because if people don't believe that the Fed will do a good job containing inflation, the trouble is that if you are a union member and you're negotiating a contract for the next 5 years and your expectation is high inflation over the next 5 years, which was the case in the 70s, the trouble is that if you don't think the Fed is going to do much about it, then I'm going to bake that increase over the next 5 years, which will then become a self-fulfilling prophecy. And that's exactly what happened in the 70s. And since the 70s, I think the Fed has really looked at inflation as being probably the more important of the two. So interest rates would go up, slow economic activity down, but then at some point kind of flip and then do the other, change direction. The thing to know about this, folks, is that if the Fed looks at the data that they look at and they think, oh, inflation is going to be higher than we would like it to be, it's unlikely for them and they shouldn't necessarily cut rates. That's the first thing to know that you would expect that the inflation data is the one driving decisions. So when the Fed started to cut rates, the inflation was on the way down, which is fine. But if inflation comes back because of tariffs or because of oil, if you're the Fed, what would you do? What are they supposed to do? And the reality is that the Fed is going to say, "Well, I don't want to take a chance with the with cutting rates and perhaps sending the signal that I'm more concerned with the economic activity, which that snowballs to that expectation of inflation staying high." So I think the Fed whether they cut rates or not, it's really going to depend on what the data says. If we see some inflation, which is possible, it's possible that I think with the tariffs, about 90% of the tariffs for last year were absorbed by consumers and businesses. And if businesses start passing more of that to consumers, more of the cost of the tariff, you're going to see higher prices. If oil has an impact and shipping gets more expensive because of higher gasoline price, well, you're going to see that. So the Fed will actually, make a decision on whether to cut further based on information on inflation. And as of now, I think it's like a 50-50 chance because you don't want to hurt the economy. You could help the economy a little bit if you cut the rates. On the other hand, you can significantly hurt it if you cut too early. So that's kind of the balance that they're working on. And frankly, I'm not sure that every Fed member has the same opinion or they all know exactly how they're going to vote. So it's, from your perspective, what does it mean to you? I'll wrap up with this. The Fed is considered to be all powerful. And it does have an impact on rates. But there's one element that all of you ought to know, that the biggest impact that the Fed has is on short term interest rates, meaning that loans that have to be repaid very quickly. The shortest of those, overnight loans, and then going all the way to about 1 month. And that's whether it's a business to business, or you're a company that has to take a loan to make payroll, or the government borrows for 30 days. That's the impact. That's the type of rate that Fed impacts the most. And to see there's a difference between that short-term rate and the borrowing costs that are longer. For example, 10 years for the U.S. government. So if you go back to let's say in the fall of 2023, when rates are very high. If you look at the 30-day interest rate, which is the one that the Fed controls, it was about 5.3%. And you look at the 10-year interest rate, that was about 5%. So it was actually lower at that particular moment in time. And by August of 2024, inflation was still an issue, and the Fed did not want to let down. We didn't have information on that, so the rate that the Fed controls was exactly the same. And yet somehow, this is where it gets interesting. The 10-year interest rate dropped without the Fed making any moves from 5 to 3.6%, a huge drop without the Fed making any moves. And then by the end of 2024, when data came along saying, hey, inflation is now well contained, we're on the right track, the Fed cut rates 3 times, and he went down to about 4.3% from 5.3. But what's interesting is that the 10-year interest rate actually went from 3.6 to 4.4. It moved up. It moved up, even though this one moved down. So the longer term rates are not driven by the Fed. They're not. They have a mind of their own. They're driven by other factors. What do I expect inflation to be over the long run? What's the uncertainty around the government and how much they have to borrow? Fed independence, other risks associated with this. But here's where it gets interesting. If you look at the history of this 10-year interest rate that I talked about, which is not controlled by the Fed, this is going back to the 70s. The line itself doesn't have a lot of meaning, to be honest. Like, you can look at it. The point of this line is to compare the interest rate on this 10-year treasury with a 30-year mortgage rate. And visually, you tell me, do you think there's a connection between the two? And it certainly is one. And in that respect, if you're thinking about mortgage rates, those are not controlled by the Fed, because the 10-year interest rate I just showed you, it's not really controlled by the Fed. It has a mind of its own. And that is really driven by other factors than the Fed. So not every interest rate in the economy, particularly the mortgage rate, is controlled by the Fed, but rather there are other dynamics that drive it. So because of that, what happens to the Fed cutting rates or not cutting rates? It's not going to be super meaningful to a lot of you, because unless you have very short-term loans, unless you put money into a CD at the bank, which has to buy these very short-term instruments, it might not make much of a difference to you, the Fed cut rates or not. I think it's a little bit of hype around that, rather than like, oh, this is going to impact my life tremendously. No, the 10-year rate, I would argue, is much more meaningful to you.
Okay. Thank you, Apollo. It's always so helpful to kind of review the fundamentals of economics and when we're talking about interest rates. So I appreciate that data. I think we'll move on now to, everyone wants to know about AI and if
Right.
an AI bubble. Artificial intelligence is increasingly recognized as a transformative technology, with parallels drawn to the internet boom. So how should investors approach this technology, as some stock prices have skyrocketed on high expectations, but yet unrealized profits?
Yeah, and that's a really important one. Because AI, I mean, I imagine, Jack and Andrew, you have you played with AI?
Of course, of course.
Going back to 2022, I think I asked one of these tools to write a poem for my wife, and they're like, she looked at it as like, you did not write this. It's pretty magical in terms of what it can do, and particularly now after years of development. So it is a transformative technology. I think that's the right way to think about it, similar to the way the internet was in the 90s. So how should you approach this? I mean, to begin with, I have to acknowledge that it will have an impact on jobs. It will have an impact on society in general because of deep fakes and all the things that we can do. And there's no question about it. So we can spend a whole day just talking about the impact, the risks associated, the benefits associated with it from an economic perspective and social perspective. And at the same time, I don't know that that's the best use of the time that we have right now, because the point that we want to address is from an investor's perspective. How do you think about AI? And the first consideration that I think of is that when you look at AI right now, to your point, a lot of the companies have great expectations built into their price for the profits that they will generate. And at the moment, it is a situation where huge investments are being made. And how big investments are being made? Well, it turns out that if you look at four companies, Amazon, Facebook, Google, and Microsoft, among the four of them in 2026, they will invest a lot of money in AI. How much money? If you look relative to the size of the economy, there is only one single investment in the history of the country that is bigger than what these four companies will plow into AI. And that was the Louisiana Purchase in the beginning of the country. That's the only other bigger investment that was made relative to the size of the economy. So it is, it's a huge investment. And at the moment, to your point, like these companies haven't really figured out a way to monetize these products. They might figure it out down the road, but right now the price is just baking in the expectation while they're spending a lot of money. So because of that, I would be very cautious to overemphasize these particular stocks. The second thing that I would say, you should still own them, but not go overboard on that. Because the second factor is that quite often when a technology like this comes along, the bigger beneficiary might be companies that don't have anything to do with AI. If you think of the scanning technology of the supermarket, well, who benefits more from that scanner? The company that made that scanner or the supermarket itself? In other words, the users of a technology might actually benefit more than the creators. And I think that is really important. And that is a reason that you want to own logistics companies and pharmaceutical company and retail, because they all might be benefiting more from AI than the AI creators, pharmaceuticals, and particularly like you think all the treatments and all that can come out of that. So in that respect, should you still own AI? Absolutely. How much should you own AI? If you look at the US market, the S&P 500, these are the largest 500 stocks in the US market. The Magnificent Seven, which are typically associated with AI, and that would be NVIDIA, Microsoft, Google, Facebook, Tesla, Amazon, and Apple. When you look at those seven companies together, they are so big that they represent roughly about 35% of the value of the US market. So if you simply bought the S&P 500 index as a fund, about a third, more than a third of your money would be into these Mag 7 associated with AI. Now, the same exact seven stocks are also part of NASDAQ. And what's nuts is that instead of 35%, they amount to about 54%, which is just a whopping number. More than half of NASDAQ is in these tech stocks. And the way that we would approach this and the way that we suggest to investors is absolutely you want to have a piece of these companies. But because of the reasons that we mentioned earlier, instead of plowing 54 or 35%, if you put them in the context of a global portfolio, not just US companies, but companies around the world, the same exact seven stocks will be part of your portfolio, but in a smaller percentage, roughly at about 19%. So the first kind of main suggestion to investors is to own these companies associated with AI commensurate to their value in the global allocation. Now, should you be afraid of the bubble? You hear the bubble, 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 and the parallels drawn to the internet. Well, it is interesting because it depends on how you define bubble. If you think bubble means that, hey, some companies are going to blow through money, create nothing, go out of business, it's likely going to happen. For sure, it's going to happen, in my opinion. Not for sure, nothing is guaranteed, but it's very, very likely. And the way to think about this is that if you go back to the internet days, there was not a single entity called the internet. There was not a monolithic investment called the internet. In fact, what you had are a bunch of companies. And the way to think about these companies is are horses in a race. They're all competing. And particularly as the race gets going, it's not obvious at all who the winners will be. And if I take you back in a time machine to the mid 90s and I say, well, there are three websites, one website that sells toys, one that sells books, and one that sells pet supplies. And I asked you, well, which one of these will certainly become the future of internet retail? It wasn't obvious at all. It wasn't obvious at all that Amazon will become that. So what I have to say is that you have to accept that in order to own Amazon, you also will have to own pets.com and eToys. And if you hyper focus, oh, but they went out of business, you miss the fact that Amazon became Amazon. You miss the fact that the same era generated Google, which is a money printing machine. Netflix changed entertainment. You have Facebook, you have Salesforce, you have Microsoft. All of these are giants today that came from that era. The trouble is that you couldn't tell at the time that they will become that, and it wasn't obvious at all. So to me, we're in that moment right now where when you look at AI, it's not a monolithic investment. It's not an entity called AI, but rather a bunch of horses in a race. And at the moment, it's not obvious at all who the winners will be. But what it's very likely is that some of these will burn through a lot of money, billions of dollars, create nothing, go out of business. And in fact, that's sort of like what I would expect because you look at the startup funds in Silicon Valley that are so famous. Well, they'll tell you if we put money in 10 companies, we know that six are going to probably blow through the money, create nothing, go out of business. We know that's the case. One or two are going to chug along, nothing to brag about, maybe to get acquired. And one or two are the moonshots that are more they're going to make up for everybody else. And that sort of private equity venture fund logic is now permeating in the stock market to all of us when it comes to AI. Some AI firms really are not going to, they're not going to survive. We just don't know which ones. And because of that, the better strategy is to own them all. And it's not just about new tech. If you look at the US stock market over the past 100 years and you take at the beginning of a 20-year cycle, the roughly 3,000 companies that start in the US stock market comprehensively, not just the large ones, small ones, all of them together, what you see is that about 60% of them actually disappear. Only 41% of stocks survive a 20-year cycle. 40%, that means that 60% just go away. And out of the ones that survive, only 18%, fewer than 1 in 5, actually outperform. So very similar statistics to the private equity market, which kind of leads to the same thing. Yes, I wish I can tell you the 18%. Everybody's looking for those. The trouble is that if you just search for those, you have a 1 in 5 chance of finding them. You have a 4 in 5 chance of finding a loser, and that's not a good thing. So that's why you kind of need to own comprehensively and accept the fact that if some companies go away, I'm totally fine because the ones that survive are likely to more than make up for the ones who don't.
Wow. Yep. Affirming diversification always.
Yep.
That's great. Okay. Thank you. Do you have any thoughts about that?
I love the analogy to the horses in a race. And my son is 14 and I was telling him about pets.com back in the thousands, and there was a Super Bowl campaign that they did, and it was everywhere, and I remember it. I'm dating myself, but and he could not believe he the same thing. Like Amazon used to just sell books on the internet. That doesn't even make sense. How could that happen? So to your point, like who could have possibly known back in those early days that Amazon would become what it is today, and pets.com is nowhere to be found, So I think that's so relevant. And to your point, diversification, global diversification too.
Absolutely. That's the key.
Okay, so we still have some more time. And I think the next theme or question is around the de-dollarization and the global standing of the US dollar. And with the recent developments, including US retrenchment from global trade and an increasing size of the national debt, alarms have been raised about potential erosion of the dollar's status and the world's dominant trade and reserve currency. How valid are these concerns? Should investors consider taking any action as like increasing international equity exposure? And then if you can even touch on how it might impact US government bonds.
Yep. Yeah, that's a big one, and I have to say that the dollar losing value and the standing in the world, and you also touched on this idea of what about international stocks? What's been remarkable is that for a long time, when we've been talking about this idea of global diversification that we touched on earlier today, and in fact, it really shone through last year and this year as well. So being globally diversified, it ought not to be tied to the dollar. It ought to be tied to your plan. And I think really successful investors have had exposure to international stocks, and they don't need to go buy stocks from abroad today, but they should have had them, and so they capture the great returns that they delivered last year. But when it comes to dollar, what's interesting is that there is that the narrative that somehow the dollar is losing value. And let's start with the euro. And if you look at the dollar compared to the euro, and this is a public website, is the European Central Bank, and you look at just again the level itself might not be as meaningful as the sort of the visual. When you look at the visual right now, it does not appear that somehow we are at some unprecedented levels of loss in value. In fact, what's amazing is that at the beginning of the year, pretty much the average, the long-term average of the exchange rate was exactly what we saw in the market. So we're not seeing something that is like incredibly different than the past. We're pretty much at the long-term average. And in fact, what's incredible is that there was a huge stretch going back to 2003 for about 10 years when the dollar was significantly lower in value, significantly lower than we're seeing today. What we're seeing is that we had a huge run up from 2020 to 2022, and then it's lost some value back in 23 or so, and then it just went up and it just goes down. But it's nothing that's terribly unusual that we're seeing right now. So to begin, when you look at the data, you don't see that huge, tremendous impact. Now, there's one thing that you gotta know. When the dollar gets weaker relative to the euro, two things are happening. Number one is products made by US companies that are being sold in Europe actually become less expensive because of this exchange rate. So counterintuitively, when the dollar gets weaker, it's a benefit to American companies. It's not a benefit if you're a traveler, but to an American company, that's actually a benefit. And secondly, it also is a benefit to US investors. Because if the German market or the French market has a certain return in euros, if the dollar gets weaker, we would see a higher return, a higher performance on our statements by the time you convert the dollars. It's just the mechanics of the math, the algebra behind it. So the note here is like three notes is like it's not terribly concerning because it's not terribly unusual where we are today. Secondly, is that it's actually a benefit to businesses and investors, and not so much to travelers. Now, the third note is that this is only relative to the euro. When you look, for example, at the Japanese yen, what you're seeing is that it's exactly the opposite. The dollar has been getting stronger. So it's not that the dollar is losing value left and right, not at all. Relative to the Japanese yen, it's about 160. And frankly, I was in Tokyo not too long ago, and I was getting about 130 Japanese yen for a dollar. Right now, I would be getting about a 160. So the dollar has actually increased in value relative to the yen. And when you compare it to another huge trading partner, China, it's pretty much been flat. There's no real difference here that we've seen over the past 10 years or so. So it is not something that is generally like, oh, the dollar is losing value. That's a narrative. It's not necessarily backed by data. In fact, it's not backed by data at all. So you got to be cautious there not to read too much. It's just a normal fluctuation that the dollar has, and it's being over dramatized. But you mentioned the idea of a reserve currency. And when you look at the reserve currency, what it means is that other countries, they might want to hold dollars. And when you look at 2024, that's the last time that I looked at this. When you look at the percentage of all the currencies held in dollars, that was about 58%. So it's still the very, very dominant, very dominant currency of the world. And you compare it to what it was 10 years before in 2014, and what you see is that it lost a little bit of ground, and so did the euro. And who gained a little bit were the Japanese yen, the sterling, the pound, the British pound, and the Canadian dollar. And the Chinese renminbi went from nothing to close to nothing. So it's certainly not at all like there's just a huge loss here in the in the exchange reserves. Now, what's also interesting here is that do I expect that the dollar is going to continue to lose ground? Well, the first thing is, which is so interesting, is that what we saw over the past decade is that that one, not just the past decade, but in general, that central banks, when they hold dollars, they don't stash the dollar bills in the vault. That'd be silly. What they do is they try to buy something that would make them money, and that is typically government bonds. So a lot of these foreign exchange reserves have been invested in government bonds because they're safe, they're liquid, they're transparent. But as the U.S. became a little bit more uncertain, because there's a perception that perhaps the government might weaponize the dollar, and there is some counterparty risk. Well, I have the bond, but you promised to repay me, and what if the government decides one day that you're a national security threat and I'm not going to pay you? What we've seen is that some of these dollar reserves moved from the ownership of bonds to the stock market. So we did see a drop in the reserves in bonds, a move to stocks. So it's not that the dollar itself has lost some ground. Not at all. And I don't really like, is it possible that one day it might not be the dominant currency? It's possible. I just don't think it's likely anytime in the near future. And there are a few reasons for that. Number one is that there is no credible alternative. If you're not going to hold dollars, what is the currency that tickles you? What is something that you really feel like, oh, this is awesome. I love to hold this currency. And don't say Bitcoin because, or if I put a suitcase full of dollar bills on the table and I put a USB stick with supposedly the same amount of money in Bitcoin, you tell me which one would you choose? I mean, like the reality is that everything we consume in our life, the taxes, everything we do is in dollars. So dollars is still the not only in the US, but abroad is the most coveted currency. Last year I was in Europe, and just for kicks, I exchanged dollars into euros, but also Chinese renminbi. And just for kicks, I went into a store and I told them, well, I don't have euros. Can I pay you in dollars? Not particularly happy because, oh, I got to go and exchange it, but sure, I'll take it. Everybody took the dollars. And in a couple of stores, I went and I offered, well, I haven't exchanged the Chinese renminbi in euros. Can I pay in Chinese renminbi? They looked at me as like, am I on candid camera? Are you nuts? I'm not taking this crap. I have no idea what it is. Like, I don't trust it. Take it out of here. Like, no. So the reality is that most people in the world prefer dollars. And you can see that in the way that exchanges work. Right now, 93% of all foreign exchange transactions involve US dollar. 93%. 93% involve US dollars. The next one is euros, and euro pairs are about 5%. Japanese about 1%, everybody else about 2%. So there's no alternative currency. And again, I'm offering for anybody on this call to tell me, well, I prefer some other currency. I travel the world, and I trust me, everybody will take dollars. Nobody will take, likely something else. The second point is that you also need to think that countries don't just hold the cash, they want to invest it. So you need to have really good financial institutions and markets, like whether it's the bond market or the stock market, because they need to do something with that currency. And frankly, again, we are the biggest bond market. We have probably the most robust stock market in the world, and nobody else gets even close to us. And the last point is that, a lot of these pipelines of trade, like there are pipes where the money flows, and they were built around dollars. Like there's a SWIFT payment system and all these things. And countries could theoretically go around them. And Russia and China, for example, yeah, we'll talk to each other and we'll trade in that. The Chinese economy and the Russian economy, for that matter, it's like less than 2% of the global economy. and they would love to trade in dollars. Nobody wants to trade in dollars with them. So if the fact that a minuscule part of the world transactions happen in some other currency because they're not allowed, don't read too much into it. The vast, all the pipes of moving money have been built around dollars. And so far, nobody has even attempted to build something parallel to that. So until you have those, it would be incredibly hard for the dollar to be dethroned. So I think there's a lot of speculation out there. I think it's a lot of fear mongering, in my opinion, whether it's from marketing or people are just disingenuous about it. Frankly, I've seen some newsletters that are peddling fear just to get people to buy their products. And a lot of times they say, oh, the dollar is going to lose its value and you should buy gold or something else, as if, if something really happens to the dollar in the financial system, what are you going to take a bar of gold and shave a little bit to buy milk? I mean, what exactly are you going to do with that gold if you don't have a financial system?
Yeah, I think that you brought up some really good points there, as I would have expected, but also a little bit of humor in that conversation too. But I'm curious about the idea. I want to just do a quick follow up related to
Mhm.
the government debt.
Yep.
So there's so much government debt right now. This
Yep.
question of will it even be paid back, and how might that impact government bonds? Would your answer still be the same? To the world is built around U.S. dollars and this
Yeah.
global system.
Yeah, absolutely. So that's a big number. So let's just put some numbers out there because it is important. If you look at 2025, last year, we owed roughly about $36 trillion in debt. So that's with a T. We owe a lot of money as a country. And to get some perspective, we have been borrowing and borrowing. In the last time that we actually had a surplus, meaning that we collected more in taxes and were paying back the debt was in the 90s. Since 2000, over the past 25 years or so, we have been adding to the national debt. But if you go back to 1991, when we actually started to repay the national debt to some degree, we owed exactly a tenth in 1991, 3.6 trillion. So over the course of these 3 decades or so, we've increased the debt tenfold, which is it's a lot of money that we owe. And there are a few things to note. First of all, like over time, I would expect numbers to go up. For example, the stock market now is 10 to 12 times bigger than it was in 1991. The economy is a lot bigger. There are more people in society. So the fact that we moved up in number, it's not really that super unusual. I'm not surprised by that. Secondly, is to your point, are we ever going to repay this back? Well, if I lend the government money and they owe me the principal back, let's say $1,000 from the bond, one thing they could do is go to Jacki or Andrea and say, "Hey, listen, ladies, would you want to lend me $1,000 and I'll pay you interest?" And then they would take that money and then pay me, and that's something called roll the debt, meaning they can push the debt further and further out. And the government has been doing this for a long time, not terribly unusual. But what's interesting is that the government can get away with doing that, but what they cannot get away with is paying interest on the debt. They have to pay interest on the debt. So if you go back to 1991, when we owe 3.6 trillion, at the time, about 3.1% of the value of the entire economic activity happened. We went into paying interest on the debt. So 3.1% of what's called the gross domestic product, which is the value of everything we produce in the country, went into paying interest on the debt. And that was at 3.6. Last year at 36 trillion. In fact, as of 2 weeks ago, when the Fed published the new numbers, I encourage all of you to guess what is the percentage of the economic activity today that goes into paying interest on the debt. And what's remarkable, it's pretty much identical. It's 3.1%. It's identical.
Wow.
Well, how can that be? It seems like, wait, this is unreasonable. Well, there are two reasons. One is, first of all, the economy is a lot bigger. So the fact that the numbers are higher, it's not really that tremendously crazy. But the other big one is this. If you go back to 2009, and this is when President Obama, for example, got in the White House. At the time, we owed 11 trillion. In 2025, we owe 36 trillion dollars. So over the course of these 15 years or so, we accumulated 25 trillion out of the 36 over the past 15 years. And what's remarkable about this particular period, 2009, particularly to 2021, to be more precise, is the interest rates were so low. They're like almost zero. So the government was able to borrow money at crazy low rates, which really helped us. And in fact, what's remarkable is that if you look in 2021, this is 4 years ago, instead of 3.1, this percentage was 1.5, half of what it is today, because rates didn't go up till 2022. And that's where we are today. So today we're in a situation where, you look at the debt that's being refinanced, and the interest rate to refinance that debt is going up. And that's where we move from 1.5% to 3.1%, is because now we have to pay a higher rate. Again, remember, the bulk of the debt was borrowed at incredibly low rates. But as you have to refinance, if these rates are high, that's when you're going to see the interest payments go up for the country. So are we in trouble? Is that sustainable or not? And you're gonna have different opinions. And frankly, like, I'm not here to kind of entertain any one opinion or one thought, but rather look at data. And I think today there's a mechanism that allows investors around the world to vote with billions and billions of dollars. And when I mean vote, is really kind of tell us what they believe the sustainability of the American government debt is. And that is in the form of the interest rate that they accept. The government cannot force any of us to lend money. We have to do it voluntarily. And not long ago, the government was borrowing for 10 years at a rate of about 4.2%. It's roughly the same today. It's a little bit different, but not, it's vastly, roughly the same. And what's important about this is that us as investors, we're okay to give the government the money for 10 years and take 4.2%, and the government was fine paying this interest rate. But the thing is, the government was not the only entity that wanted to borrow money for 10 years. The largest bank, JP Morgan, they wanted to borrow money. And even though they would have loved to pay 4.2% in interest, market participants were saying, no, we are not going to lend you money for 4.2% because we don't perceive you to be at the same level of risk as the US government. And you go down the road, great American company, Ford, right there in the Midwest. They can borrow money, but the market is saying, not so fast. I'll lend you money, but it has to be commensurate to what I perceived your risk of repayment might be. And Nordstrom, it's a great department store. We all use it. And yet, if they borrow money, they have to pay a higher rate. So the voting mechanism, to me, Andrea and Jacki, is really like, what is the interest rate that investors accept? Because that is sending you a signal on what the belief is on the sustainability of the debt. And as of now, the same that it's been the case, the U.S. government is the most is considered to be the most robust borrower, and that's kind of where we are today. That doesn't mean it's not going to change. It could change, and things do change. And to give an example, not of the U.S. but a different country, if you go back to the financial crisis in 2008, at the beginning of the year, German bonds and Greek bonds were both offering about a 4%, roughly about a 4% interest on their bonds, and people were willing to pay. And it's just, I'll take the 4%. But by mid-year, news came out that the Greek government might have trouble repaying that debt. They were not sure they're going to repay it. So how did the market manifest that? Well, in the cost of borrowing. The German bonds went down to 1%. And at the same time, what you saw is that the Greek bonds went up to 54% to compensate investors for that uncertainty, the possibility of not getting paid back. So to me, the mechanism that I would use is this voting mechanism that the market's using through the interest rates that investors are willing to accept on a relative basis. And as of now, again, what we're seeing is that the U.S. government is still the bedrock. And if that was to change, we'll have another webinar, talk about it. But as of now, let's cross that bridge when we get there. Right now, it's still markets have confidence that despite all these big numbers, the government will find a way to manage this debt.
That's great. That's very reassuring to hear. And it makes a lot of sense when you put the numbers down on paper. I see billboards that describe how much debt there is in the world, and it ticks up right as you watch it.
Yep.
That, I don't know if you've ever seen those billboards.
Oh, I've seen those.
Yes.
There was one in New York, I think, for a while, like that they moved from one place to another. Yes.
Yeah.
I
So
mean,
that's
there's also, yeah.
fear mongering, like what you were talking about. It's sort of like the, being afraid and then trying to sell a product or something out of that fear.
Absolutely. I mean, there's a billboard where I live in Los Angeles that looks at the smoking deaths, and that's the same billboard. And that's scary. That's real scary to see how many people. But the reality is that these are not pretty numbers. I'm not here to tell you that I'm sugarcoating and this is all milk and honey, everything. No, no, no. I think that there ought to be some changes that are being made because at some point we do have to address this. What I'm suggesting is that the markets at this moment in time, they have a level of confidence that politicians will eventually find a way to solve it. In the previous situations where we had, for example, Social Security troubles, well, there was a moment it's like, okay, we actually need to fix this. So a legislation was passed, and all of a sudden we started actually collecting more in Social Security benefits than we paid out, and we started a Social Security trust fund. And for many, many, many years, we collected a lot of money in the trust fund for the times like when we actually have to dip into that fund. So I think I think that if you look at a lot of decisions that the politicians make in Congress, they tend to be when they're confronted with something stares them in the face, and that's when they tend to get it. And that's, I think, what the market's reflecting is the expectation that ultimately the politicians will do something about it. Not that this is like, oh, it's great, don't worry about it. No, I'm just saying is that there's a level of expectations in the ability of the government to actually make some changes down the road when we hit some of those harder times.
Yeah, that's basically like human nature, making decisions when you're confronted.
Yeah.
Okay, well, I mean, we're not going to get to like gold and Bitcoin because we are almost at time, and we just really appreciate Apollo. You're all and Dimensional, like you provide so much education to us and support to advisors, and so we'd love to have you back again, but we know you're very busy. And we just thank you so much, and thanks for everyone that attended today. And we can follow up with y'all later. Did I miss anything?
We're going to be sending out a recording.
Oh,
We
yeah.
did a recording of this. So if you'd like to watch the recording later or have additional questions after that, of course, please feel free to reach out. Thank you so much, Apollo. It was
Thank you,
wonderful
Apollo.
to meet you.
Great fun talking to you.
Together.
Thank you.
Care.
Bye-bye.
Bye.
Thank you.